Okay, so let's just get right into it. There is something really strange happening in the economy right now, a massive paradox. On the one hand, you see the stock market just soaring, hitting one new high after another. But on the other hand, pretty much every reliable historical indicator is flashing bright red, basically screaming that a crash isn't just possible, it's overdue. It honestly feels like we're defying financial gravity. So that brings us to the big question we're tackling here. How is this all holding together? Why hasn't the whole thing just broken down already? Well, the answer involves three hidden forces that, frankly, Wall Street would probably rather you didn't look at too closely. And here's the kicker. The fact that it's taking so long might actually be the most dangerous part of this whole cycle. Or to get a sense of how weird things are, let's start with a favorite metric from the one and only Warren Buffett. He likes to compare the total value of the stock market to the country's entire economic output, its GDP. Well, right now, that ratio is at a staggering 220%. To give you some context, anytime that number has gone over 100%, historically, it's meant the market is way, way overvalued. And this chart, wow, this really puts the scale of the problem in perspective. Look at this. Right before the dot-com bubble burst back in '99, this ratio hit a peak of about 115%. People thought that was insane. And then the market collapsed by over 60%. Today, we are nearly double that level. We are in completely uncharted territory here. So you've got this enormous gap between market prices and the actual real economy. Our source material calls this the Great Disconnect. So in this first part, let's dig into a couple of key numbers to see just how detached from reality these valuations have really become. And you can see this delusion is really concentrated in a few key places. The historical average price-to-earnings ratio for the S&P 500, a normal, healthy level, is around 15. Today, it's sitting closer to 28. But just look at the extremes. You have companies like NVIDIA trading at over 50 times earnings, and at one point Tesla was up at 286. I mean, people are paying absolutely astronomical prices for these stocks based on promises of future growth that are anything but guaranteed. This isn't some new thing. Sir Isaac Newton, literally one of the smartest people who ever lived, said this after he lost his entire fortune in a speculative bubble 300 years ago. It's just a powerful reminder that while history might not repeat itself exactly, it sure does rhyme. So if the fundamentals are this weak, what on earth is propping all this up? Well, that brings us to the first of those three hidden forces we talked about, a massive, totally unprecedented flood of new money being pumped out by governments and central banks. And this whole process is explained by a principle that's actually been around for centuries. It's called the Cantillon effect. Here's basically how it works. The government and the Fed create trillions of new dollars out of thin air. But that new money doesn't go to everyone equally. No, it flows first into the financial system, to the big banks and the large institutions. And what do they do with it? They buy assets, which in turn drives up the prices of things like stocks and real estate. So who's really benefiting from all this? I mean, this chart just makes it crystal clear. The top 10% of households in the country own nearly 90% of all stocks. So this money flood is, in effect, a massive wealth transfer. It pushes asset prices higher, making the wealthy even wealthier, while everybody else is left dealing with the inflation that it inevitably creates. Okay, let's move on to our second hidden force, which it really builds directly on that first one. See, it's not just about the amount of money that's flooding the system, it's about where that money is being forced to go. The entire structure of the market has become dangerously concentrated around just a few fragile giants. In a healthy market, you have broad participation. Lots of different companies in different sectors are all doing well. But today's market, it is incredibly narrow. Its strength is almost entirely dependent on a tiny handful of AI tech giants. And this massive concentration risk is then made even worse by the explosion in passive investing. And this is a really critical point. Over half the market is now owned by passive funds like ETFs. And these funds, they don't pick stocks based on merit. They just automatically buy the biggest companies in whatever index they track. This creates a really dangerous self-reinforcing loop. As more money flows into these funds, they are forced to buy more of the same giant tech stocks, which pushes their prices even higher. But, and this is key, it's a two-way street. When the market turns and people start pulling their money out, those same funds will be forced to sell, which will just amplify the crash on the way down. And now for the final, and maybe the most mysterious, force holding this whole system together. This is the one that our source material says Wall Street has the biggest incentive to keep quiet. A colossal amount of risk that has been deliberately tucked away, completely hidden from view. So where did all this risk go? Well, it's been moved into what's called the shadow banking system. The easiest way to think about it is like a parallel financial world. It's full of lenders and private funds that aren't subject to the same strict rules and oversight as the big regulated banks that we all know. And the scale of this thing is just immense. We're talking about a $4 trillion system that's operating in the shadows. This is where all the riskiest, most highly leveraged lending is happening now, far, far away from the eyes of regulators. So here's the crucial point. After the 2008 financial crisis, new laws were passed that were supposed to make the official banking system safer. But what really happened was a clever bit of financial maneuvering called regulatory arbitrage. Instead of actually getting rid of all the toxic risk, the big banks simply shifted their riskiest activities off their own balance sheets and into this unregulated shadow system. So the regulated banks look stable on the surface, but the systemic risk is absolutely still there. It's just been hidden from sight. So we have these three incredibly powerful forces: the money flood, the fragile giants, and the shadow risk, all working together to prop up the market. But what's the trigger? What's the catalyst that could finally bring it all crashing down? Well, according to our source, it's not going to be a number on a screen. It's going to be a psychological shift. Market collapses almost always follow a very predictable sequence of human behavior. Let's break that down. There are basically three phases. First, you get irrational staying power, which is where markets stay completely disconnected from reality for way longer than anyone thinks is possible. You could argue we're deep in that phase right now. The second phase is crash fatigue, where investors just get numb to bad news and stop reacting. And then finally, you have the confidence break. Some single event, a surprise bankruptcy, a credit event, it triggers a chain reaction, and suddenly that crash everyone's been talking about finally and very quickly arrives. So, given all these hidden risks and fragile systems, what's the actual takeaway here? Well, this explainer isn't about trying to make some exact prediction of when a crash is going to happen. It's about understanding the deep underlying structure of the system. The core message from our source is that true financial security really begins with intellectual security, with understanding the rules of the game you're actually playing. And a prepared mindset really means understanding those rules. It means focusing on owning real, productive assets, things that actually produce income or have tangible value. It also means holding some of your value completely outside the conventional financial system, in things like physical gold or other scarce commodities that can't just be created with a keystroke or frozen by a third party. Because when you boil it all down, the entire financial structure that we've been talking about, it isn't really backed by gold anymore. It's not even backed by genuine productivity. It is backed by one single, very fragile thing: confidence. And as history shows us time and time again, confidence is one of the easiest things in the world to lose. So why hasn't the market crashed yet? Because these hidden forces, this flood of easy money, this extreme market concentration, and this regulatory game of hide and seek, they're all holding the illusion together. But the laws of financial gravity haven't been repealed. They've just been temporarily suspended. And when that confidence finally breaks, the snapback to reality is going to be incredibly sudden. And that leaves us with one final question to think about. The entire system runs on confidence. How strong is yours?